students of Ukrainian-American Concordia University. Today I will hold a lecture on financing international or foreign trade. And there are several aspects, so I will divide this lecture in different parts, and I will show you that here on my presentation. So I have to share the screen. So you see here, finance of international trade. And you see here also short and long-term finance. And these are the main different parts because the tools and instruments are so different between these two, short and long-term finance. So if you look for that, these will be the main parts, but I will now go on and ahead with remarks on short-term finance and some general remarks as well. So you see here short and perhaps also medium-term methods of payment instruments. And on the left hand, there you see some typical things where banking are helpful for some credits or loans or financing. So two main parts also here, non-documentary methods. That means you will have a credit line on your account or anything else. And then the documentary methods, these are really different tools. And we'll look for both. And if you look on the right hand, short, medium-term financing, there are some special tools as, for example, factoring or forfeiting. That's just an overview. Even if we will concentrate in the first part on short-term finance, here some aspects of the long-term financing that you have an impression why it is so different, and that we will do that in a several part. See here, particularly on the right hand, forfeiting, rollover credit, leasing, and others. And therefore, we will do that in a separate way. So some remarks on short-term finance. I tried to make clusters or look for in which case can you use which tool or instrument. So you see here, first of all, IM or export financing. Left hand import or right hand export. Then you can divide it again before shipment and after shipment, or pre and post shipment, in both cases for IM and export. And then below are the instruments. And the instruments are divided in two groups. You see that by the orange headlines. So we have guaranteed credits or liquidity. And that's also the same for IM and export financing. And then you can use, for example, a guarantee for financing import before or after shipment. You can use the same tool, some special guarantees, also in export financing. Then you will not find that tool in export finance, but only in import finance, letters of credit or time draft, acceptance of bills of exchange. And then the typical, I would say the typical instruments to finance, these are, for example, overdraft facilities, or better perhaps, credit line on your account. And you will find that again in import and export financing. Look for the green one, or a very special one, bill discounting. Then you will find money market, and we have to talk then what money market is. You will find that also in import as well as in export finance. Then fine trading, that's a very special tool, but also deferred payment and others. So that's very often the same instrument, which you can use in different cases, therefore. And the only thing I want to do with that slide here is to show you in which case you can use which tool or instrument. So for example, now going ahead with some pre-shipment tools or instruments, you can, as you have seen on slide before, can have that as a guaranteed credit or as liquidity. And now I want to explain you a little bit what I understand under a guarantee, and therefore my example here. Excuse me that there are some German words, but the whole thing is a guarantee. What is a guarantee for? In that case here, we are talking about a guarantee for warranty obligations. That means that the good fulfills what it needs to be fulfilled. Now, what is the content of a guarantee? The very first part here means we are informed that, and so on. That's only corresponding to the contract to show why the guarantee is established, nothing more. And then the very first important part is following with now, therefore, we, the bank, hereby, and then very important words, irrevocably and unconditionally guarantee to pay. So without any other, let's say, interruption or whatever, if you receive a first written demand as a bank that is certifying that the seller has not fulfilled his obligations, then the bank will pay a certain amount. So again, it's important irrevocably and without any other condition, the sum will be paid on first written demand, certifying that the seller has failed. Then the bank will pay, and regardless of any objections on the part of the seller. So the seller has no chance to avoid the payment. So that's the main part of the guarantee. Then some aspects how to fulfill, how the bank can fulfill, and so on. So the guarantee comes into force, and then there is a certain day liability under this guarantee will be reduced automatically with a payment. And written form for the beneficiary of the guarantee if he wants to claim payment. Then again, here in that case, guarantee shall be governed by German law, can be any other. And also the second thing you have to have is place of jurisdiction. So law and jurisdiction. So the critical thing here for in that case, the seller who ordered the guarantee at his bank is that it is an abstract instrument. So it has nothing to do really with the goods. If here the beneficiary of the guarantee, in that case the buyer, states that the seller has failed in a written form, then the bank has to pay. So the bank has not the right to approve if it's correct or not, if the goods are correct or not. If the beneficiary of the guarantee says, here the guarantee, I want to claim because seller has failed, then the bank has to pay. So therefore, it might be also a little bit critical for the orderer, here in that case, the seller of the guarantee. Coming back to the presentation. Second example for guaranteed credit, so no liquidity at the moment, is that one here. So the case to explain. If a party wants to import, then the problem is that the importer does not want to pay in advance. Why not? he will not know if the seller of the goods will really send the goods. So paying in advance means you're taking all the risk as an importer. But on the other hand, the exporter does not want to deliver the goods without knowledge that he receives payment. Then he would take the whole risk if he is sending the goods without payment. Therefore, we have a very special instrument of the banks. These are letters of credit. That means the bank guarantees to pay if some, I would say, some terms are fulfilled. And we will see that here in that document. So here in that special case, bank has established that guarantee, or better to say, that letter of credit. It's an irrevocable, can't tell the other party, oh, no, it's something changed. We don't want to guarantee anymore. No, it's irrevocable. Then here are some days, some dates, and name of applicant, name of beneficiary, and so on. Here the important thing is, sorry, I have to go to this page, that it is sent, the goods are sent to, in that case, port of destination. And description of goods, including here in that case, the so-called Incoterms. How to approve that that was fulfilled? So the bank then wants to have manual signed commercial invoice, a packing list, full set insurance policy, premium paid, full set clean on board, and certificate of origin. In that special case, GSP Form A, that's General System of Preferences, that's because of reduced duties. Against these documents, the bank will pay. And the documents are, at least for the importer, but the bank looks is that really the document manually signed, or is that a packing list threefold? Is that full set clean on board ocean bill of lading, showing that the goods are sanded, and so on. And if the documents are correct, then the bank has to pay. It's a must. If the bank, or the other way around, the bank can't say, oh, goods perhaps not correct, or the importer says goods are not correct. Even if the documents are okay, then the bank has to pay. Then here are some other things to be organized. Here in that special case, documents must be made out in English language and so on. But that's not so important here in our case. Why have we chosen that tool here? Because not only one party wants to take the whole risk, That means paying in advance from the importer's point of view, or sending the goods without payment from the exporter's point of view. Therefore, we have the intermediary, the bank, who guarantees to pay after presentation of the named documents. And problem only is that you should be nearly sure that you receive the correct goods documented by these so-called documents required. Then the next one, liquidity. And here I will look for money market. And I have to change again. Now, here we are. If you want to know the interest rates, the most known are the Euribor interest rates. You can really look for these and read more, and I will show you the data. So it seems that I've forgotten my login dates. So I'll come to that, back to that later. But let's have a look here. With the delayed rates. And you see here again, oh, I have to use my login. Come back to that later. Let's try to do that in another way. So interest rates, for example, for you need a credit for 3 months. That's the time. And after that time, you will pay back. Interest rate at the moment might be per annum. That means a yearly based interest rate. What is the advantage of this credit? Relatively low interest rates. Disadvantage? You have, in every case, to pay the interest for the whole time. Even if the opportunity from your side would be you can pay back earlier. So that is not possible here in that case. So, and I will look for that I can present you some actual rates, perhaps with that one here. Let's have a look. You see here, that is perhaps the better one. So you see, I have a problem to share the correct screen. Here you have some examples for the interest rate. That's to be explained. This interest rate, here we had the example of 3 months, but that interest rate here is only the interest rate between banks. That means that the customer of a bank has to pay a certain amount more than that one here. Might be that the bank charges additionally 2% for the work they have to do, for the risk of the customer, and so on. That's only the interest rate between banks. So sorry that it's a little bit hands-on, this lecture. Would be a little bit easier if we could do that in a lecture hall or even online. But these are the very first things on guarantees, letters of credit, or money market credits. And the tools are usable in not only pre-shipment, but also after shipment, or in the case of export. Only the letter of credit is only for import possible. So that should be enough on short-term financing in the case of questions, please do not hesitate to contact me. And I try to answer your questions. So thank you for your attention. All the best. The students, welcome to the second part of financing international trade. And I will start with some general remarks on interest rate calculation. So just a short moment that I can share my screen. So here we are. So I want to get you familiar with some general remarks on interest rate calculation. So the first example, calculation of interest for discounting, or to say it with another word, upfront payment of interest rates. Upfront means in advance before you receive the credit or the loan. Here in my example, I compare the situation paying interest after the credit line or after 1 year, and that in comparison to paid in advance. So if you have the rate of 6%, then it should be in every case 6% if you pay that afterwards. But what is the case if you pay that upfront? That it is called a discount rate, and it's deducted from the credit before you receive the amount. That means here in that special case, 50,000 as a credit line or credit, 6% are 3,000 if you calculate for 1 year. And then you receive not the 50,000 as a credit, but only 50,000 minus 3,000. That means 47. And if you now want to know the effective interest rate, you have to compare the interest of 3,000 to the credit of 47,000. And you see here, it's 6.38 in comparison to 6.00. If you pay that after 1 year or after that. You may compare that for different cases. Do that, for example, with another one discount rate 10% and then compare the result. Second, calculation of interest rate for less than 1 year. That means you have to pay not only after 1 year, but 4 times a year. For sure, not the whole interest for 1 year, but only the fourth of it. So you pay that quarterly. And I give you here the formula for that. If you pay that for a year, then you have K as capital. Should do that with perhaps also with a C. Then 1 plus the interest, and the exponent here, N, would be then for 1 year only 1, for 2 years 2, and so on. If you do that quarterly, you have not to pay the whole interest for 1 year in a quarter, but only the fourth of it. that you have to do that 4 times a year. So 4 multiplied by n, the number of years here. Do that for a certain interest rate, let's say 6%, and compare the two results of the formula. And then you will see what. And I'll do a short break that you have the chance to do that by your own. So the result is that you have to pay more interest if you do that quarterly. Coming to the long-term finance of international or foreign trade. You do that, and here we are mostly or only looking on export business. And if you do export business, there are certain risks for receiving your payment. There might be the commercial risk, means the customer gets an insolvency or has some cash flow problems. Or, and we do not hope for that, but there might be also change of mind or conscious fraud. If you have no commercial risk of your customer, of the importer, but even then you take some risk because it's possible that because of political influences, it's not possible or allowed to make the transfer. And here are different political or country risks listed, as for example, macro risks. So that is, whole state gets an insolvency, or institutional risks, or confiscation, for example, or at least an embargo. Another field of risks are the currency or foreign exchange rate risks, or in that case also convertible risk. That means it is not allowed or restricted to exchange one currency into another, or a moratorium. That means that payments are stopped. And at least for your calculation, interest rate risks, that means that the interest rates are rising and you have no chance to compensate by a higher price for your sales. So you see many different risks, mostly concerning also the country risk. Second aspect might be producing of machinery, selling of machinery. And here you have to be aware that the time between acquisition and the last payment is very often a long one. Means you have a certain time for acquisition up to that point that the sales contract is signed. Then you're producing, and if it's machinery, it might be that you have a certain time for the production, or need a certain time for production. Then you can deliver the product to the exporting country, and then you have to give a certain time for payment. And at least, and that is not very certain, it is for more than 2 or 3 or 4 years from the first acquisition to the last payment. Here are some examples how to finance and how to secure the payment. Here I'm focusing on the German Export Credit Agency. The abbreviation is ECA, and the German one is Hermes. What does Hermes or an export credit agency do? They take the country risk or insuring the country risk so that not the exporter has to take the risk, and therefore also the bank is really willing to grant a loan or to finance because it's not a risk or a lower risk for them. Here are the steps. For example, first step, sales contract. Then in the sales contract are the terms of payment, and might be in a certain case that the bank becomes the creditor of the importer. So therefore the bank pays the exporter the whole amount and is waiting for the payment from the importer. But we will focus on that later. What kind of exports are usually financed? Not services, but, for example, goods. Not consumer goods, because very often the term fast consumer goods is used. So they are used or consumed the goods, and they are not as a security anymore for the loan. So therefore, durable goods, long-lasting goods. And here, very often, or typical goods are machines. So not short-lived investing goods or investment goods, but durable goods again. Also not short-lived machines, but perhaps plants, facilities. So not only goods, but whole plants. Big plants for production abroad. And these are very often in developing countries situated. So the blue are the possible goods for long-term financing. And then remember my slide for the long finance. That means from acquisition, signing contract, production, delivery, and then payment. Here I made a chart showing also first acquisition. You have to spend therefore also some money. Then you're signing the contract and starting the production. And this is the steep rising expenditure. On the other hand, perhaps you have the chance for a part of an advance payment. And that is a very typical term of payment, you have to pay as an importer every 6 months part of the whole amount. Therefore, the stair, they function here. But nevertheless, the problem is the financial gap in between these two. And that is what you have to finance. And that is perhaps a long-term credit. How to do that? I skipped some slides to give you some examples. Remember, Export Credit Agency, that's a part here below in the left low corner. The exporter at the top of the left, the bank on the right hand, and the importer also on the right hand on the top. And the financing institute. Here in that case, it's a Swiss institute, the UBS, but can be also any other if you use or are situated in another country. So first, delivery of goods to the importer. That you see the cover on the left hand. So first of all, the ECA, the Export Credit Agency, here in that case, that's a Swiss one, is ensuring the exporter that he's able to cover the mostly country risk, but also the risk of the importer, that the importer will not pay or cannot pay. But the cover is also necessary that the financing institute here in the middle is aware that the risk for the exporter is really not high. Now, the supplier, the exporter, sends the goods to the importer without any payment in advance, without payment. Therefore, it's called a supplier's credit. Look, the red line on the top. And then it's possible that the financing bank, therefore, is doing the credit line for the exporter. Look for the red dotted line between exporter and financing bank UBS in the middle. Then it might be that also the buyer's bank will be involved. That can be another kind of credit. So then the Swiss bank here in the middle, the UBS, will have a credit line with a buyer's bank, or give the credit line to the buyer's bank. But let's have a look on some typical credits, because it might be not easy to understand with that slide here. First one, forfeiting. Forfeiting means you're selling your receivables without any recourse. That means the exporter sells receivables to the bank. So in a first step, look for the arrow with the 1. The exporter has some receivables because of sending goods or selling goods to the importer. Then he has some claims or receivables that can be supported by a promissory note. That is something similar to a bill of exchange. Arrow 2. These receivables he's selling, the exporter is selling to the bank. Arrow 3. So the bank gives the exporter, arrow 4, the whole amount, but minus a discount, minus the interest for the whole time. Then the exporter has the money for these exported goods, and the bank is the holder of receivables. Therefore, arrow 5, the bank becomes the creditor of the buyer. And last step, the buyer has to pay the debt to the bank. So that's one kind of a long-term credit for financing exports. Long-term means because receivables are perhaps payable after 2 or 3 years. Here is a calculation for such an example. So the discount of that is at 7%. So the bank is discounting 7% from the amount of the contract. Here, in that special case, we had also a down payment and so on. I will explain. So contract amount, first line, 2 million, 100%. Then the importer has to do a down payment of 15%. So the rest to be paid is 85% or 1,700,000. But now the question is, and here I made the calculation before, the importer has to pay interest on the open part of a receivables. That means the not paid receivables of 8.77% per annum. So these are at least 409,000. Both together, the receivables to be paid plus the interest to be paid by the importer is in whole 2,109,579. Now, look for the calculation at the bottom here. Discounted amount, minus some fees, plus a down payment, at least are 2 million again. So that's a contract value again. And the discount or discounted amount here, forfeited amount in the middle, is also 1,700,000 because you have the chance to finance the amount of 2,109,000 by 7% for some years. I will show you that with an Excel sheet in the next step. So same figures. So I made one mistake. It's not 7% the discount, but 7.125, the exact one. And here again, some very special aspects. I don't want to explain the whole of it because it's a little bit too complicated. But at least what we have seen here is that you have the chance to do the forfeiting or selling the amount to be forfeited of 2,109,000 with a discount of 7.125. And now let's have a look here. That's a finance for then 5 years. And the open balance is reduced every 6 months by the 170,000. And on the open amount, you have to pay the interest of 8.77. And that's that one here. And The discounted amount, therefore, is in every case that one. You see here the sum of the whole, what the importer has to pay, the open account plus the interest in that field here, and the sum of it is again 2,109,000, what you see here as a forfeiting amount. The thing is, the exporter has to pay 7.125, but he has to agree with the importer that the importer has to pay not 7.125, but around about 8.77. You remember payment in advance and afterwards. That's the difference also here. Think on the slides before, where we made the example between 6% and 6.38. Another example. Sorry for I prepared that, but we have to have a look on the next one. Here in that case, not a forfeiting is a case, but a so-called buyer's credit. I will explain also here the certain steps. So first of all, as in the example before, step one, exporter is sending goods to the foreign buyer or importer, and therefore he has some receivables. Therefore, he's asking for some securities. Might be a promissory note or any other. But then the bank, exporter's bank, for example, grants a credit to the buyer. Perhaps the same securities as in arrow 2 are now given to the bank. That's the reason why the bank grants a credit to the buyer. And now the bank pays the whole amount in step 5, arrow 5, to the exporter. So the exporter also in that case receives the whole amount, and the foreign buyer redeems the loan with the interest. That the bank will do that. Also in that case, we have the cover or insurance by a so-called export credit agency. That's a governmental insurance. And so the foreign buyer in step 6 pays the interest and the loan to the bank. Exporter receives just a few days, perhaps after delivery, the whole amount for his exported goods. So in both cases, as here, buyer's credit or forfeiting, the positive is that the exporter receives the money early, just a few days after delivery, usually. and the bank will finance and is taking the risk, perhaps covered by an export credit agency, and that makes it easier for the exporter because the exporter has now the liquidity to finance his business. And therefore, these two are very helpful for export business. We can have many, many different aspects and details for long-term finance, but I will finish here because the only thing I want to do here is to give you a short overview on what is possible finance in a long-term way. So long-term, we had now two examples. Here the buyer's credit, and the next one had been for fading. Very good tools because exporter receives money very early. So far, up to now, thank you. And again, if you have some questions, I'll try to answer. And here, my email address again. If you have any question, let me know. And also, please do some calculation with my formulas on the first slides of this lecture. Thank you so far. Hope to see you. Bye-bye.